Good morning, everybody. Kirk Spano, December 6th, 2019. Happy St. Nick's. I hope you got somebody something nice for the stocking this morning. I forgot. In any case, I've got a screenshot up here for you. This is a conversation that I had with Mark Yusko back in July 6th, 2017. And he was claiming that the stock market was in a euphoric state at that point. And I made the argument that, just seemed like back then it was enthusiasm. So this part of the chart, not exactly a bubble, probably getting towards overvalued, which I suggested at the time. In fact, just 6 months later, we made that very, very profitable volatility trade as we kept going up the chart. At the beginning and end of 2018, we got the corrections that I suggested in that 9 to 19% range. And now suddenly in 2019, we have a SPY of over 300. It's about 320 right now. And the markets are rallying because we had good unemployment news, sort of. And we'll get into that in a second. So I think, as I've been discussing with you for several months now, that we're about to hit euphoria or delusion. And sometime next year, the market will start downward. And we'll get that chanting of denial that, oh no, everything's okay. It's just a little mini correction. And we'll get a rebound. And the people who are in denial say, I told you so. And then we'll get a bigger correction. Crash 2020. And we've been through the reasons why the crash will happen. There already is a trickling out of money from the very wealthy. Executives are selling stock. Family offices are reducing equity allocations. In January, there will be another group of people turning 70 and a half. Another 3.7 million. It's about 10 or 11,000 people a day. So over a year, 3.7 million more people turn 70 and a half next year. That is all money that comes out of their retirement plans for the required minimum distributions. And the pensions are in a chronic state of selling their equities. Why? Because the pensions don't have new money coming in from younger people. In fact, the pensions are underfunded by somewhere in the neighborhood of $4 to $6 trillion. So in about a decade, they've got big problems paying their benefits because they have no growth. Their bonds are getting 1% and 2% and 3%, and they're pulling money out of the stock market. I would argue that the pensions ought to be pulling money out of the bond market. I think there's more risk there because if we do have helicopter money or more quantitative easing at some point, it's going to impact the actual interest rates for them. So they'll get lower interest rates, and then if the bond vigilantes come back, then they actually will take losses as interest rates go up. Because, again, they don't have new money coming in to reinvest. So pensions are doing things backwards. The typical mantra that they follow of fewer equities is wrong, and they're going to bankrupt themselves. So at some point, we have to bail them out. How long from now? Seems like around a decade, because that's when the maximum number of people taking out of pensions will happen. So, euphoria. The stock market doesn't care about any of that. It doesn't care about a pending retirement crisis that we'll get in about a decade because, hey, it's a decade from now. What me worry? So we're going into delusion. We have a big stock market rally today. What's another sign of delusion? Who Take a look at the work here. Who can tell me what this number represents? 280 million. Put a dollar sign in front of it. Come on, somebody's a baseball fan. Nobody? No New York Yankee fans? Ooh. $280 million is about what Garrett Cole is going to get as a free agent pitcher. The Yankees are preparing a record offer. 8 years would be the record for a pitcher, and $35 million would be the record for annual compensation, just beyond Zach Greinke's $34.25 million. So congratulations, Yankees. You're going to spend over $250 million on a pitcher who will be 37 or 38 years old at the end of this contract. Delusion. Garrett Cole is great, but he's 29, and it took him quite a while to figure out how to be great. So the good news, I guess, for the Brewers is now that we're willing to listen on Josh Hader, is that the Yankees probably want to go all in for next year. And this is, telling me that the Brewers might get a really, really good deal from the Yankees for Josh Hader, because he's the cheap kind of reliever that they need. So we'll see. In any case, delusion. Here's your headline. Stocks climb, Treasuries slump on solid U.S. jobs markets. So again, the pensions cutting their stock positions. Stocks keep going up, and Treasuries slump. Pensions are very poorly managed. So let's take a look at some of the numbers. If you go to the BLS, Bureau of Labor Statistics, they give you all the numbers. And they tell you that we had 266,000 new jobs in November. You have to realize there are a ton of people who went to work for Amazon and in retail. And those adjustments will show up in a month or two. There's a release on the front page of this. Let's see here. That shows the preliminary revisions for last year. They have huge revisions. So this revision was 500,000 jobs fewer than they reported initially back in March or April. March. So don't get too carried away with these headline numbers of, oh, look, 266,000 jobs. Because they have to go back and revise that for, okay, what was really a permanent job and what was just a hire for seasonal, and they'll back that out. But the market doesn't care. It goes up and up and up and up and up. Stocks. Up 302 on the Dow. Now, nicely, we got rid of our hedges a couple days ago, made basically a break even on the VIX trade, but that gave us cash, and we'll take a look at our model portfolios here in a second. And there's probably a couple additions. We reduced our cash a little bit, so hopefully everybody did that. In any case, back to unemployment and employment. You can see who's making the money. Wages really have just, in the last couple of years, gone up a little bit, which is a little bit more than before, but still just a little bit. Here's what people make, and look at how many people are making under 20 bucks an hour. Look at, I can't move this and still keep it all the time, but look at the number of people in these professions, right? Retail, leisure, and hospitality. None of them make 20 bucks an hour. The average in America is about 26, 27. Your average teacher makes the average wage. Manufacturing folks who typically don't have a high school education also make the average wage. So teachers and in manufacturing, average wages. teaching people did not finish education, but they usually got a skilled trade, so that's good. Actually, that's not even true in manufacturing necessarily, but some of them do, some of them don't. Professional business services, a little overpaid. Financial activities, we're all overpaid. Mining and logging, I actually think these guys should make more for the dangerous work that they do. But again, not typically a high school education, so they don't get the raises they probably deserve. Wholesale trade, construction, these guys should probably make more as well. They're building the world. Utilities. So I have told my kids, and I've told a lot of kids, if you can get a job working at a utility, you should take it. Why? Because they pay really well. And I think a question you should ask is, are these wages what they should be? Are they more valuable than some of these people? I don't know. But take a look at tech. Now imagine in the smart city world that's coming, in the smart grid, combining information with utilities. If you got a kid, you got somebody going into college trying to figure out what they want to do, I've always told you, learn as much math as possible. But if you can find a way to apply the skills that these folks have, you're going to get paid very well, especially if you're throwing an MBA. So there's your advice for the grandkids and kids. Unemployment rate for people 25 years and older. Again, this is by education. You can see less than a high school diploma, some college or associate degree. And this is a lot of the folks in skilled trades. And then college degree. So what does this tell you? All these folks that are out there telling you there's a bubble in education, again, we're going to use that presidential word, bullshit. There's no bubble in education. Is it too expensive? Yes, it's too expensive. But this idea that to be not educated is somehow smart is dumb. I'll have to pull that one right out of the transcript. So we want education. We want skilled trades. We just want to get it done for cheaper. In fact, skilled trades, which essentially my daughter is in service industry for esthetician, she's making $50 an hour. Yeah, I'm a dad. I can't complain about $50 an hour. We just saw that, that's top of the table, man. $50 an hour. So, keep this in mind when you hear some of those stupid arguments out there. What's important about this is that, right, everybody's can find a job right now. Almost everybody. Even without an education or a skill. And you've probably bumped into this in some places where you're waiting in a line, or you're expecting some service, or you're trying to get help with something. There's folks who are just now into the labor force. They're not real experienced, not real educated, and it's going to take them some time to develop good skills. And it's going to be a learning process. So as you bump into folks who have jobs now, especially over the holidays, and you're standing in that line for 5 extra minutes, don't be a knucklehead and complain and make faces and get irritated, right? This is the product of a good economy. People get jobs that didn't have jobs, and they have to learn those jobs. They have to learn a work ethic. They have to learn how to be part of a particular culture. So don't be a knucklehead and give them a hard time. It's the holidays. Be nice. This is an interesting stat. The percentage of people who've been unemployed 27 weeks or longer, so basically their unemployment ran out, among the people who are unemployed. So back during the Great Recession, folks were unemployed for an entire year. Or excuse me, half of the folks who were unemployed were unemployed for over 27 weeks. And right now, we're chopping along that 20%. So about 1 in 5 people who lose their jobs stay unemployed very long term. If this doesn't head down to here, then that indicates that the economy, though we think it's strong, still has underlying cracks. This needs to get back down to here. You have to be 90% likely to get a job within 6 months for the economy really to be considered strong. When did this change? During the 90s, I wish that they would back this chart up a little further. During the 1990s, this economy got really good. 94, 5, 6, 7, 8, 9. And then we had the tech wreck that bumped it up, came back down. This is a little too high. That means that, that's a lot of people who are having a hard time finding work. So we have more and more people in the economy all the time, right? It's not a big growth rate, but the millennials hitting is a big deal. We still have quite a few millennial men who have never worked full time. It's a weird statistic that's out there. It's like, I forget what it is, 1 million or 2 million millennial men have never really worked full time. So there is this gap here that is hard to explain, and I don't think anybody really knows what to do with. But it is one of those things that can drive angst and uncertainty in the economy. And when we get angst and uncertainty, we get less spending, less reinvestment. And that's a problem for the investors because we need to have some growth to underlie virtually every investment out there. So we could take a look at some of the alternatives. Shadow Stats is famous for this one. In fact, they have a measure of how they did unemployment way back, I think pre-1981 or 82, that would show that unemployment's even higher. I don't know what they call it. But the U6 unemployment is even coming down pretty far. I mean, this is a pretty good curve. So we're down to, I'll show you the labor participation rate. And I'm going over the labor participation. This might not be what I'm looking for. There we go. Because as I've talked about, if unemployment turns over, that's what we have to be afraid of as an investor. And this is the chart that starts to make me worry. It's not going down anymore. It's becoming choppy. We need it to keep heading down. So labor participation rate has bottomed out. Right, started plunging after the Great Recession. And it's chopped along a little bit higher in the last 4 years. It's kind of bottomed out at the end of Obama. It's kind of chopping along up. So again, this gap from about here to about here, 3% of the population, around 10 million jobs. We need either about 10 million more jobs, or we need wages to go up in a way that doesn't slow the economy down so that households don't have to have 2 income earners anymore. So as people raise families, as the millennials finally are starting to have families here in the last several years, will they have 2 people in the workforce? I'll give you an example of something I think is going to be more common. My daughter, her fiance is working full-time, got a good job, 28 years old, making 80-ish grand, 90-ish grand. And then she's the one who's the esthetician that runs her own business. And when she works, she's averaging around $50 an hour. certain things, we want to talk about waxing and microblading and all this other stuff. I can do it because I've had to learn, because I listen. I'm a good dad. I listen. And she doesn't work full time though. Some weeks she might work full time, but other weeks she doesn't book. She might work 25 hours. So I think the day is coming when the second job in the household is either A, flexible, or B, part-time. And as a social question, we should ask, is that good or bad? But as an economic question, we should also ask, is that good or bad? And I think from a productivity standpoint, we've had productivity slow down here in the last several years. I think it's probably good, because it means that the time spent working is more productive. So there's a lot of doom and gloom out there. And I think looking through an economic prism, every problem we have is fixable. Some of the fixes require more extreme measures. I've talked about how helicopter money will inevitably be required to fix the retirement system. Social Security is underfunded by 15 to 20 trillion. The pensions are underfunded by 4 to 6 trillion. That lockbox that Al Gore talked about 20 years ago is actually what we need. He was right about that. We need to segregate money aside to pay for all these retirement expenses for the next 30, 40 years. And then set up the millennials and the Z generation to actually get benefits. So how do we do that? There really isn't any other solution than printing the money. We can't suddenly save 20 to 30 trillion dollars. We're going to have to print it, not borrow it. QE is not printing money. Quantitative easing is borrowing money from the future. There is a debit created on the balance sheet at the Treasury when that happens. I may have said that a little bit wrong, but essentially the Fed is borrowing money. So we need probably just to print that money. And if we put it in the lockbox, that means that it trickles into the economy over 30, 40 years. And that's why it would not be hyperinflationary. It would be inflationary, but that probably just offsets the deflation that we see from demographics and technological change. So when we look at all these things, we come to the conclusion that, all right, there's going to have to be more money creation to bail out the retirement system, and maybe we'll throw in a couple $1 trillion for pet projects. Infrastructure, Green New Deal, whatever, transition to Medicare for all. Who knows what they'll do? But there's a big hunk of money coming into the economy at some point. The question becomes, will we have a crisis first, or will people listen and say, hey, let's figure it out ahead of time? I don't know. Elizabeth Warren wants to take care of everything now. Joe Biden, he'd probably take the centrist route, probably even a little bit right of center, as far as I can tell. And we'd do better, but we'd probably glide towards the crisis anyway. So a couple of comments here. So somebody says, helicopter money sounds like Ray Dalio's beautiful deleveraging. Well, and it is. I talked about it 4 or 5 years ago. I was glad to know that one of the best investors and economists in the world is talking about it now. But the way to solve for a problem that we've let fester for 40 years, right? We stopped saving for the boomer retirement in 1981. I mean, there were choices made that have led to the improved standard of living, but at the expense, as Warren Buffett would say, of living high on the hog, with a bill due tomorrow. Well, the day that bill is due is about a decade from now, because that's when the maximum number of boomers are on all the benefit programs, and a lot of that money has been whittled away that does exist in the pensions. So we'll see what's going to go on. with that. But either we get a crisis that we don't fix, which I can't imagine, or we get a crisis that we do fix, or we fix it ahead of time. We'll see. Yeah. So Jeff Gunluck, who has made a lot of money as an investor, is saying that the next recession, the stock market will get crushed and take very, very long time to come back. Here's why I agree with him partially. One, I do think we get a mini recession, or what I've called a skip straight recession, in the next year or so. But I don't think we get that big, huge recession for a while. So I think that there's different terms and different scenarios that play out. But I think the small recession that's coming, or the skip straight recession that's coming next year, is going to crush the stock market. I've told you that. Hashtag crash 2020, or I originally said pound crash 2020, and my kids said, what the hell is pound? Hashtag crash 2020 on Twitter. We'll get that correction next year for a whole host of reasons that I started describing earlier. And part of the stock market will come roaring back. Another part of the market is going to have a very hard time. That old economy, high capital, high debt, no growth part of the economy is never coming back. And that will keep the averages from looking like they're getting as high. But you're going to have subsegments of the economy that have 10 and 20, 25% growth rates, but between 10 and 25% growth rates. Those parts of the economy, which are generally asset light, right? You've heard that term in the press, asset light, and they can create goods and services without huge new capital investment, and they have their good margins, their double-digit margins. That part of the economy is going to do very well. And that's why I keep talking about the transition to this new smart everything world and the developing alternative energy system and everything attached to smart everything and alternative energy. It's coming. That's where the growth is. And take a look at NASDAQ. Which companies in America have the most money? Google, Facebook, Apple, all these tech companies. And some of these biotech companies are getting bought by the pharmas because the farmers are like, oh man, we need these products, and they got great balance sheets. So the NASDAQ 100, if you're looking for blue chips, is the place to look. Are you going to get as high of a dividend there as you would going out and buying some highly leveraged old economy stock that says, hey, we're a dividend aristocrat? No, you won't get as high of a dividend. But when this stock market drops, a lot of those dividend aristocrats, and this is what one of my newest articles is, are going to get crushed. They're going to cut their dividend, they're going to get crushed, and they're never going to return. And those are the stocks that will keep the averages from getting back to where they were right away. So we'll see exactly how it plays out in time sequence and how long it takes. The next decade is going to be very interesting. So you're seeing the picture. Is the picture blurry right now? Well, hopefully closing that helped out. So this article I actually put on the free site after I showed it to you guys. Close our VIX trades. I posted this, but I haven't talked about it. We have the investment planning and coaching add-on if you need it. But I just want to pull out some of these model portfolios. And by the way, our chat's been really good lately. So if you're not looking at the chat, you should be. So we're looking for dividend stocks, for an asset allocation, for retirees, want total return. even in a retiree portfolio, you have to have QQQ and at least a little bit of the innovation. Now, I put a chart over at TradingView, and I'll pull it into an article. ARK Innovation, interestingly, all of their gains are due to the trading of Cathie Wood. All of them. So the fund has outperformed the top holdings in the fund, which means that it's trading, right? The fund can't outperform the holdings unless you're trading the holdings, which is what she's doing. So this is one of your few shots to have an active manager who's in the right part of the economy, right? Innovation, growing stocks, low capital intensity, and she's trading well. But the solar ETF has done very well. This iShares Clean Energy pays a good dividend. They're doing better than the S&P 500. So this is a stock that actually has a beta similar to the S&P 500. So you're not really taking on any more volatility, but you're outperforming the S&P 500. Invesco Solar is more volatile, but it's crushing the S&P 500. Gold miners we're going to get to in a second. Gold's getting beat up today, GDX. So if you don't have some money in GDX, buy these dips. I'll show you some charts. I don't know if today is the day to buy, but probably doesn't hurt. These are two countries I'm high on. The rebound potential in Malaysia is huge. They're just so beat up. And Australia never really ever loses, so that's a plus. But as scarcity returns due to underinvestment in resources, Australia probably does pretty well, especially when China, primes their pump. And then here's some stocks. Nutrien got down to 46. I added a little bit more Nutrien. Newmont Gold has done very well for us. What is it, up 30% since we bought it? Plus we have 2 sets of premiums. Kinder Morgan. I think you can buy Kinder Morgan. They have kind of chopped along sideways. And there was something that happened recently. I can't remember what it was, but I think it's temporary. Something to keep in mind on Kinder Morgan. Richard Kinder is 78 years old, and he's been buying as many shares as he can. What do we know about 78-year-olds and older folks? They're looking for an exit strategy, right? Richard Kinder doesn't think he's going to own this stock 30 more years. He built this company. He's broken the company. He's repaired the company. And now he's buying as many shares as he can. Not little purchases. I mean, he's pumping hundreds of millions of dollars into buying Kinder Morgan shares. One of two things is going to happen. I guess 3. He dies. He pays his family pays the estate tax to the extent that they didn't set up trusts and whatnot to avoid it. And, stock goes on its way. At some point, though, I think what we're really looking at with Kinder Morgan is either he sells the company, which could happen by the end of next year, because then he can lock in his lower capital gains rate. So selling the stock is probably his best way of maximizing his return when you take into account the different tax scenarios. The capital gains tax is probably a better way for him to avoid taxes than trying to get around the estate tax with shares. So if he sells the company, he'll pay 20% capital gain, and then he can flip that money into charities or whatever he wants to do to avoid a lot of the estate tax. He could do that with shares, but typically charities sell the shares, so Berkshire Hathaway is an exception to that rule. So I think Kinder Morgan is something you can buy if you want a pipeline company. Remember, they're biggest natural gas pipeline in America. And there's really no competition coming on with them anymore. We had the big pipeline build out under Obama, and pipelines have just not been getting built very much lately. So we'll see. Most of the pipeline projects are finishing up right now, right? The stuff that started 4, 5, 6 years ago, or was approved in that time range, they're all getting finished. Dakota Access was finished. They might do a little add-on. All these Permian pipelines, which I have an article coming out on, are just about finished, which is why the Permian companies, the spread has disappeared on their oil. So now they can get oil to market full price. And what do we find out today? We find out today that OPEC is putting more pressure on oil prices. So hopefully we get a rebound in some of our energy stocks, and then we can make decisions based on asset allocation without being so underwater. This is where that comes from. Crude oil jumps. OPEC confirms deeper oil production cuts. Tanker trackers, if you follow me on Twitter, tanker trackers, so people put out the information, saw that about 400,000 barrels a day are not going to get to international markets out of Saudi Arabia. And that jives with the 500,000 barrel a day cut. So tanker trackers, there's some resources out there that are really good. I've encouraged you, have a Twitter feed and just pick out your favorites. I try to tweet out as much as I can, but I don't tweet out everything that I read. Enphase. Enphase is a stock that I'm very high on. The more and more I learn about it, the more I like it. So Enphase is something that you buy the dips on. And if you want to get to know Enphase, here's what Seeking Alpha really is best at. Not the college kids writing articles. It's not these guys that crank out 10 articles a week. Who the hell can do research on 10 things a week? It's crap. This guy, though, is in the solar industry. He's an installer. What have I told you about the contractors being the linchpin in alternative energy? This guy writes about several things, but he's really almost just an expert on Enphase and everything in photovoltaic and grid alternatives and things like that. But, take a look at this guy, legit credentials. He understands this market, and he's really explaining what's good and bad about it. And he's talking about Enphase. So Enphase has contracts with solar producers, solar panel makers, and they put their the Enphase inverters directly into the solar panel. So there's two types of inverters. One that's basically snapped together, like what these guys are doing, and then the one with the big wires, like what SolarEdge does. Now, there's a use for both. In bigger projects, you're going to need the wires. But in rooftops, these guys are going to crush it. So whether it's a commercial rooftop or your home, these guys are making, these guys are almost a monopoly there. So any dip that you can get on Enphase, I think you should be buying it. I mentioned it and Dave mentioned it around $20 a share. It's about $24 a share now. At a minimum, sell puts down in that $20 range, or $22 range, because I think this is a stock that you want in there. Remember when I said that I think SunPower can go to 100 because they're going to convert to being a commercial and residential company that works with the contractors? These guys, same vein, different product, but I think these guys can go to $100 as well. So, or higher. So between SunPower and Enphase, because they have the massive upside and similar risk as everybody else, I like that. Now I buy TAN, the solar ETF, just to get the broader exposure, but then I drip in a little bit of these guys in SunPower because they have just massive upside. The other one that I'm going to probably add at some point is Sunrun. the right one. Yeah. And they're not in here quite yet, but you can take a look at Sunrun as well. Their relationship with Costco, I think, is a big deal. I just don't know when it all drops to the bottom line. So in any case, read TJ Roberts' articles on Enphase. You'll come away with it very good understanding. The oil stocks, I covered a few of them again. ConocoPhillips, I don't know that we need to buy it. I think it's probably the safest one out there of the independents from a balance sheet perspective for broad. But I actually still think stick with the Permian plays. So Devon Energy, more Permian, and Encana, more Permian. I think that they have a big strategic move coming here with Encana. Again, like I said, stick with the Permian companies. Pioneer Resources has the least amount of debt. So not only are they a Permian pure play, but they've got very low debt and great assets. I think this is a company that you should buy here while it's depressed. Right? It's chopping along. It's up $3 today. So I'll let it breathe on Monday and maybe buy it, middle of the day or late Monday. Starting to get some cash into it. But more importantly, the long-term trend down is basically maxed out. These oil stocks can chop along for a while. And if you want to wait a few weeks or a month or two to really expand your holdings or start some holdings, go ahead and do that. But this is indicative of a long-term selling period, right? 7-8 months. And it's pretty much played out. This is as bad as it gets. So even if it never gets back up here again, right? Should get to here-ish. So that means there's an uptrend coming. The bull market in oil that I thought started 1.5 years, 2 years ago, and was preempted by the Iran sanctions not really being sanctions, and the trade war is going to come at some point. Here's why. There's been very little investment in offshore oil. Depletion rates are increasing, right? More oil you take out of a well, the faster it depletes because the oil gets harder to get. We're going to have a supply-driven rally in oil that lasts several years until demand really turns over. I got huge arguments by saying, let's pull up that chart one last time. Well, not one last time, but one more time. When I said that the peak oil demand is close, right? Peak oil demand in the 2020s and then turning over in the 2030s. This looks super steep. Just look what the scale is, though. So to go from 105, 106 million barrels a day at the peak, that we sit on that plateau, peak plateau for a while, before it turns over because more people are buying EVs by 2030. And I do believe EVs will outsell gasoline cars by 2030. And then demand comes down. By the middle of the century, we're using half as much oil. It's not going to go to zero. There's just too many things and too many legacy products and factories and whatnot. But you should see the comments, and the 900 comments now on this article. And people just, they look at this and they go, they just go nuts. But this is about what's going to happen. Could it be pushed out a little? Sure. Could it start a little sooner? Could it not be quite as dramatic? Yeah, all those things. But this is proving to be about right. And in fact, Rystad Energy just came out 2 days ago and said this is basically their model. Put in a report. They didn't steal my chart. They made their own chart, but it looks the same. They're basically Rystad Energy's model too. And BP Energy is saying it now. So you got an oil major saying it. Total is preparing for it. This is the future. but there's going to be a rally right in here, right? Where demand is above the supply line. Then at some point, demand falls faster than supply can fall. Right? So at some point, we have super cheap gasoline again, maybe in the 2030s, in which case, you probably want one of those gasoline cars laying around. I'm going to have one. You know, somebody's going to tell me I'm going to go to hell for it, but whatever. If that's what sends me to hell, then I've done okay. All right, let's finish up with gold and then some questions. This stock's done very well for us this year, right? When we started buying it, I told you because of the merger, this was going to happen. So we bought the stock, sold covered calls, and sold puts all at the same time. That was our opening transaction. So there was 2 sets of premiums. We bought at around 33-ish. 2 sets of premiums. Most of us should have a cost basis around 30, 31 bucks. It's up to around 40. It's off a little bit today. The big thesis around the oil producers, or excuse me, gold miners, is that there's been huge consolidation in the industry. During this period, they repaired their balance sheets, right? Gold goes from 1900 back down to 900. Rebound on just rebound how things work. You know, when you think about Elliott wave theory, and you know, it's not perfect, but it's about right. Right? You see a wave. They're just waves. Selling, hope, despair, right? And then you get the rally. And it comes back to earth. And now it's chopping along for a very long time, and it gets that capitulation. People get tired. New investors come in, right? This is new investors coming in. Hiccup from the merger. This has probably got waves much higher. Why? Well, let's take a look. This is the market vectors gold ETF. Let's take a look at the holdings. Newmont and Barrick, 2 biggest companies in the world for gold. They actually control about 70% of gold production, yet only 22% of this fund. Why? Because they cap the fund and they want to keep it a little bit more equal weighted. So this fund, you do not ever need the junior miners fund. Ever. Don't ever buy the GDXJ. Ever, ever, ever. Because then you get nothing but crappy little companies. You want the leaders. So if you want a diversified gold portfolio, gold stock portfolio, this is diversified. Plenty of little companies. And then I add Newmont, because I think Newmont is an awesome company, and I might add Barrick. Why? These 2 companies control 70% of the market of the new gold found in mined. There used to be 4 companies that did that. Now there's 2, right? Newmont and Goldcorp merged, and Barrick and Randgold merged. What do we know about consolidation in any industry? They're able to control supply. If demand goes up, they make a lot of money. What if I'm right about helicopter money? What if it's only QE? Who knows? At some point, we're bailing out the retirement system, and these stocks do well. I believe that we have a multi-year bull market coming in gold miners. And I don't think gold's going to get much over $2,000 an ounce, you know, but I think that'll be the range, you know, 1,500 to 2,000. But that's a lot of money dropping to their bottom lines here, these gold miners. Take a look at the maximum chart here. So I was buying gold stocks way back in about 2000, 2001. In fact, I bought Barrick. I bought Barrick in here. Sold it here. And I even wrote 2 articles about it on MarketWatch about a year apart. One in 2011, one in 2012. And in 2000, maybe it was 2011. Yeah, it was 2011, 2012. Because when it crashed, the second article, and maybe it was 2013, there are 2 articles on MarketWatch. One in here somewhere, and one down here somewhere. And this is the article where I wrote, you need to sell your gold holdings. Here's why. And I talked about how the dollar was going to get stronger. And then down here, I picked on the gold bugs. I basically said, it wasn't hard to call this one. And teased them here because it's fun to tease gold bugs. And, they told me I was, a moron and, went down further. So here I am a year ago, right? It was about a year ago I started talking to you about gold. And now it's starting to come back. I haven't bought Barrick back yet, but I'm probably going to. Maybe I'll add a little bit today. But I need to look into Barrick. I really like Newmont though. I really like everything they're doing. Take a look at their website. They keep winning awards. Everything they're doing makes sense. I don't know that I like the leadership at Barrick. I think that this stock can make another run at its peak and probably break through it. Like I've told you with AT&T. AT&T, which we bought around 30, is now around 40. And I told you that's normally the top on AT&T in the low 40s. I think it's going to break through that. The new revenue they have coming, right? This new paradigm towards streaming services, and the fact that they have an in with Apple and they have DirecTV subscription base that they can convert over, just like Invesco is converting customers from Oppenheimer. You've got AT&T converting customers, and then, by the way, they have Warner Studios. I still think that AT&T sells off Warner. Right? They'll cut a super long-term content deal to make sure that when they spin off the company, they're not without stuff to put on their TV. But I think Warner Brothers gets spun off again. And all that money drops to the bottom line at AT&T. They have the 5G service, one of 4 providers in the country at some point. AT&T is going to break into a new higher range, just like I think Newmont is. Invesco, I'm not sure about. But in this ETF-driven world, Invesco is my horse. BlackRock, if they really dropped a lot, I'd buy BlackRock too. Newmont really, really has a long ramp up. If any of the things I'm saying about the economy come true, if we print more money in any way, these gold stocks take off. So own the fund for diversification by Newmont. And then we also own Core. And when we talked about Core, what did we talk about? What's the name of the mine? Do you know the name of the mine yet at Core? What did I tell you was the actual change at Core? Silvertip. That's right, Silvertip. Right? So when we were buying this stock down in here, right, we bought a little too high. But everybody should be very profitable on this now, because we sold puts a couple of times. Take a look at the 1-year chart. That's a pretty good chart. Yeah, we didn't do the entry perfect. We did pretty good. Plus, like I said, we sold puts a couple of times, 3 times, I think. So you knock off a couple dollars from a $5 original purchase. I looked at mine. It was $5.03. First bought it at $5.03. So it must have been right in here. Right here. And right in here is where I first bought it. I think that might have been earlier. It must have been over here, huh? 3-year chart. Where's right around $5? That look right? End of 2018? somewhere in there, must have been. But we also sold puts a couple times. So folks got shares put to them in here. But look at that. That's a pretty good run here. These guys, good balance sheet, good assets, good leverage. Everything about these guys is right. This is one of those stocks that probably could double yet from here. So on these pullbacks, I think you sell puts. And that line, let's zoom in there. Look at that chop. A little correction. If you can get back in around $6 a share, I think you're in awfully good shape. I don't know that it's going to come all the way back down here to this moving average. I think maybe. And if it does, I think you should buy the shares. In the meantime, I think you should be selling, $6.50 puts, $6 puts right in there. All right, let's end on that, and let me answer a couple of questions. For those of you who won't be listening to the question and answer, because I just try to do that live, hopefully you listen to us live at some point or join our service. I'll have an end cap on here, and I'll try to put on a special margin of safety investing. If you aren't familiar with it, running a year-end special to give you a year cheap, basically the founder's rate for a year. And then you can decide if you want to keep us after a year. So half price for a year. All right. Have a good weekend. Time for question and answer.